Hello everyone, we are student of President University batch 2024 class 2 accounting, and we are excited to explain about course Taxation 2 and Financial Management as our midterm. Before we start, let me introduce our member group, Siti Rahma and Jolie Firat. First, we will discuss taxation. Okay, let's discuss question number 1. The question number 1 explains about multi-company VAT reporting analysis. So, now we have case scenario here. PT Indonesia Group operates as a holding company with 3 subsidiaries. First, PT Retail Indonesia. PT Retail Indonesia have output VAT of 22 million and have input VAT of 13 million and 200. Second, PT Manufacturing Indonesia. PT Manufacturing Indonesia have output VAT of 55 million and have input VAT of 13 million. The last, PT Logistik Indonesia. PT Logistik Indonesia have output VAT of 11 million and have input VAT of 4 million and 400. And the tax is, first, calculate the net VAT payable for each subsidiary. Second, determine the consolidated group level net VAT payable given the total output VAT of 88 million and total input VAT of 50 million and 600. Last, discuss the benefit and challenge of consolidated VAT reporting in multi-company structure, including issues related to intercompany transaction and compliance. Let's answer and explain one by one. Number 1. Before we calculate net VAT payable, we must understand VAT. What is VAT? VAT is tax imposed on every transaction of good and service. Companies must pay tax on their sales, which are called output VAT, but can deduct the tax paid when purchasing raw material, which are called input VAT. How to calculate net VAT payable? The formula is output VAT minus input VAT. Let's we make simulation. First, PT Retail Indonesia. PT Retail Indonesia have output VAT of 22 million and input VAT of 13 million and 200. The calculate is 22 million minus 13 million and 200 equals 8 million and 800. Second, PT Manufacturing Indonesia. PT Manufacturing Indonesia have output VAT of 50 million and input VAT of 33 million. The calculate is 55 million minus 33 million equals 22 million. The last, PT Logistik Indonesia. PT Logistik Indonesia have output VAT of 11 million and input VAT of 4 million and 400. The calculate is 11 million minus 4 million and 400 equals 6 million and 600. If output VAT is greater than input VAT, then the company must pay the difference to the government. If input VAT is greater than output VAT, then the company can request a tax refund or use its a tax credit in the next period. Why should companies separately calculation for each subsidiary? Because each company have different transaction. The amount of tax to be paid is also different. By recording separately, the company can clearly understand the tax obligation of each subsidiary. Okay, the second is determining the consolidated group level net VAT payable to determine our net VAT using the tax consolidation. The tax consolidation means combination all transactions from various subsidiaries in group tax report. The formula is the same as the number 1, namely total output minus total input. 88 million minus 50 million and 600 equals 37 million and 400. Fix the tax liability of 13.7 million and 400, the same as when calculated individually. Tax consolidation have many benefits, including administrative efficiency, tax optimization, and making it easier for audits to checking reports. Besides, then there are also challenging, including misreporting risk, intercompany transaction, and different regulation. After that, we can see the benefit and challenge. We have 3 benefit and 3 challenge the benefit. First, administrative efficiency. What is the administrative efficiency? With one report, companies do not need to manage many separate the reporting for each subsidiary. Number 2, tax optimization. Tax optimization is VAT input from one subsidiary can reduce tax obligation from other subsidiaries, reduce the overall payment. Ease of audit. Ease of audit is tax inspection become more centralized and easier to control. The challenge is number one, risk of misrecording. Miss of recording is error in recording transaction between companies can cause difference in tax report. Number two, intercompany transaction. There must be clear record of transaction between subsidiaries, so there is no double tax calculation. Number three, regulation compliance. Each country or region can have different rules regarding tax consolidation, so a company must always follow the latest rules. Tax consolidation is especially useful for companies with many subsidiaries because it makes tax management simpler. However, if done correctly, it can lead to reporting error that result in fines and tax penalties. Question number one explain about KUP compliance and digital administration. So, the case scenario is a medium-sized enterprise failed to obtain its NPWP on time and subsequently delayed its annual tax return or SPT. This slide triggered a review and potential sanction under the General Tax Provision and Procedures. And the tax is number one, analyze the KUP framework regarding taxpayer self-assessment, registration NPWP, and the prescribed penalties for late filing or underpayment. Number two, discuss how digital systems such as availing and factor help mitigate risks of the non-compliance and streamline tax administration. Number three, propose corrective measure the enterprise could implement to ensure future compliance and reduce administrative error. Let's answer and explain one by one. We explain about number one first. Number one is analyze the KUP framework regarding taxpayer self-assessment, registration, NPWP, and penalties. First, self-assessment. Self-assessment is tax in Indonesia use a self-assessment system where taxpayer calculate, report, and pay their own tax. Second, NPWP registration. All companies must have NPWP. If you do not registration NPWP on time, you can be fined and administrative penalties. And the third, SPT late fines. Annual SPT reporting delay, 1 million fine for business entities. Taxpayer delay, 2% interest per month from the tax payable. The taxation system in Indonesia is a self-assessment system, which means taxpayers are fully responsible for calculating, reporting, and paying our tax because the government trusts taxpayers to manage their own tax. But if there are errors or delays, they will be subject to sanction. Therefore, companies must always ensure tax compliance to avoid fines and sanctions that can affect their cash flow. Digital tax system help through compliance. First, e-filing. E-filing is facilitates filing and sending tax report online, reducing delays and administrative error. Number two, e-invoice automate the recording of tax invoice, ensure accurate VAT calculation and avoiding fictitious tax invoice. Number three, integration system. Integration system is with digital system, financial data is directly synchronized with tax report, just minimizing input errors. With a digital system, companies can be more efficient in reporting their tax, reduce the risk of human error, and avoid sanction due to delays. In addition, well-documented data facilitates the audit process by tax authorities. And the last is for the number three is corrective measure for future compliance. Number one, immediately register NPWP to avoid administrative sanction. Number two, using a digital tax system to be more efficient and accurate in reporting. Number three, make a tax reminder schedule so that there is no delay in tax payment. This step important. Why is this step important? Failure to fulfill tax obligation can result in fines, interest, and potential tax audits from the government. With the corrective action, companies can be more disciplined in tax management and minimize financial risks. What are the positive impact? The positive impact is companies can optimize cash flow by ensuring that the amount of tax paid is appropriate and not excessive. Better tax compliance also improve the company reputation. especially for companies that work with business partner and investor. Using digital tax technology, implementing tax remindering, and conducting internal audit are the main keys to improving tax compliance. Companies that are proactive in tax compliance will be safer from the risk and finesse and unweighted tax audit. After that, the question number 3. Question number 3. Explain about impact of VAT rate change on business operation. So, the case scenario is a company operates in market where the VAT rate has recently increased from 11% to 12%. The company record a sales amount of 600 million and purchase amount of 250 million. And the tax is 1. Calculate the output VAT, input VAT, and net VAT payable for both the 11% and 12% scenarios. Number 2. Evaluate how increase in the VAT rate may influence the company pricing strategies and profit margin. Number 3. Discuss the importance of input VAT reconciliation in ensuring that the company either minimizes its tax burden or claims a VAT refund where applicable. Let's answer and explain one by one. Before we calculate VAT under 11% and 12% rates, we must know the formula. The formula for output VAT is sales times VAT rate. Formula for input VAT is purchase times VAT rate. The formula for net payable is output VAT minus input VAT. Let's we make simulation. When at VAT 11%, for output VAT is 600 million times 11% equals 66 million. For output VAT is 250 million times 11% equals 27 million and 500. For net payable is 66 million minus 27 million and 500 equals 38 million and 500. When at VAT 12%, for output VAT 600 million times 12% equals 72 million. For output VAT, 150 million times 12% equals 33 million. For net payable is 72 million minus 30 million equals 42 million.
Of course, the increasing of VAT also give impact. We can see the impact that is giving right here. There are 3 points right here we can see. The first point is if the price is fixed, the company's profit is reduced because higher tax reduce the profit margin. So, if the selling price remains the same, then higher tax will reduce the company's profitability. The second point is if the price is increased, customers may be reluctant to buy, causing a decrease in demand. Which means if the selling price is increased, then there is a risk that customer will look for alternative products or postpone purchases. And the third point is companies must choose between absorbing the tax increase or passing it on to customers. Like company needs to find operational efficiency solution to reduce the impact of the VAT increase. For example, by finding cheaper raw material suppliers or optimizing the supply chain. Company must find a balance between maintaining customers' purchasing power and maintaining profit margin. Okay, next. The inputting of VAT reconciliation also have some important point. The first point is VAT reconciliation ensure that companies do not pay more taxes than they should. If there is an overpayment of tax, the company can file a restitution or a tax refund or use it as a tax credit for the next period. And if there is an underpayment, the company can immediately make correction before being subject to sanction. The second point is if the input VAT is greater than the output VAT, the company can apply for restitution or tax refund. Recording errors can cause inconsistencies in reports and are at risk of being audited by the tax authorities. And the last point is avoid mistakes in tax calculation that can cause sanction from tax authorities. With regular reconciliation, the company has accurate data if it is audited by the tax authorities at any time. And VAT reconciliation is very important to avoid legal problem and ensure that the amount of the tax paid is in accordance with applicable regulations. And now we go to the question number 4, the scenario about stamp duty in legal and financial document. A real estate firm is finalizing multiple property transfer agreements. Each agreement requires the payment of stamp duty, which is calculated based on the value and type of the legal document involved. So there is 3 tasks, and the first task is explain the role and purpose of stamp duty in the formalization of legal contracts, referring to its significance in ensuring legal validity and compliance. The second is analyze how the stamp duty calculation interacts with other tax obligations within the overall taxation framework. And the last is discuss potential legal and financial consequences if the firm fails to remit the required stamp duty on time. Okay, so now the answer section. The first is we discuss about the role of stamp duty in legal contracts first. The first point is stamp duty is needed to give legal force to certain documents such as purchase and sale agreements, business contracts, and financial documents. And the second is documents without stamp duty can be considered invalid and cannot be used as evidence in court. So the documents that are subject to stamp duty, like sales and purchase agreements, business contracts, financial transaction document, and without stamp duty, document can be considered invalid. Documents without stamp duty have no legal force in court. If a dispute occurs, documents without stamp duty cannot be used as valid evidence, and stamp duty ensures that business documents have valid legal force in transaction and legal disputes. And now, based on task number 2 earlier, we should analyze the interaction. The interaction of stamp duty with other taxes is: first, stamp duty is often associated with PPN, PPH, and BPHTB, or Land and Building Rights Acquisition Fee. The second is, in property transaction, stamp duty can be an additional fee in addition to other taxes that must be taken into account in the total transaction cost, which means stamp duty is not a tax calculated based on the transaction value, but rather function as a requirement for transaction document to have legal force. And documents that do not have stamp duty can be rejected in legal processes or tax audits. Stamp duty works together with other taxes to ensure that business transaction and legal documents have validity. And the last is company must understand when and how stamp duty should be used to avoid potential legal and tax administration problems. After that, there are some consequences that must be faced for failing to pay stamp duty. The first consequences is documents can be considered invalid in the legal process. And the second consequences is can be fined 100% of the stamp duty that should be paid. Okay, so I will tell the explanation. So the explanation is stamp duty serves to ensure the validity of documents. So without stamp duty, the underlying transaction can be questioned, and tax authorities and legal entities have the authority to review or cancel documents that do not have stamp duty in accordance with applicable regulation. Paying stamp duty is an important step in ensuring the legality of business documents and company transaction. Ignoring stamp duty can have serious consequences such as document cancellation, large fines, or legal problems. And now we go to the last question, question number 5, the case scenario about integrated tax compliance in a multinational corporation. A multinational corporation operating in Indonesia is subject to both direct tax or income tax and indirect tax or VAT or PPN. The company must adhere to self-assessment rules and faces potential audits and disputes resolution procedures under the KUP. The first task is identify and evaluate the key challenges the corporation might face in managing compliance for both direct and indirect tax. And the second is discuss the role of digital tools such as e-filing and e-facture in improving the accuracy of self-assessment and reporting and in reducing audit risk. And the last is propose an integrated compliance strategy that leverages digital systems to ensure timely tax reporting and effective dispute resolution. And now we go to the answer section. The first section is the challenges for task number 1. We can see right here there are 3 points. The first point is different tax regulations in various countries, which is each country has different tax policies, so company must comply with different rules in each location. And the second point is transfer pricing, which is must ensure that the transfer price between companies in the group is in accordance with international tax rules to avoid association of tax evasion. And the last point is tax audit and sanction, which is if the tax report is not accurate, the company can face a long tax audit and risk fines. So, multinational companies face significant challenges in tax compliance because they operated in many countries with different tax regulations. Multinational companies must have a strong tax management system and always follow the latest regulation in each country where they operate. Task number 2, the role of digital tools in tax compliance. There are e-filing, e-invoice, and automated tax reporting. The e-filing section is ensure faster, more accurate, and well-documented tax reporting. The e-invoice section is prevent fictitious tax invoices and make tax reconciliation easier. And automated tax reporting is reducing human error in tax reporting. So using technology in taxation can reduce the risk of errors, increase efficiency, and help companies remain compliant with tax regulations. And the last but not least is discussing about integrated compliance strategy digital system. The integrated compliance strategy leveraging digital system, the first point is using ERP or Enterprise Resource Planning system to integrate financial and tax data from all subsidiaries. The second point is implement an automatic monitoring system to detect tax error early. And the last point is conduct internal audits periodically to ensure tax compliance. The digital system provides transparency, speed, and accuracy in corporate tax management. Okay, we already discussed about taxation too. I hope you can understand the explanation before. And now we go to the financial management section.